Hello and welcome back to our video lectures. In our last two lectures, we have learned how to segment a market and thereby evaluate the opportunities and threats that are available. And in our competitive analysis, we have looked at the strengths and weaknesses. So we can now summarize strengths and weaknesses, opportunities and threats into a so-called situation analysis or SWOT analysis, whereby the term SWOT stands for strengths and weaknesses, opportunities and threats. I have uploaded a video on SWOT analysis to the platform, which I urge you to take a look at. It's a short few-minute video that actually describes and defines what a SWOT analysis is all about. The overall evaluation thereby of a company's strengths and weaknesses, opportunities and threats is called a SWOT analysis. Thereby we have two different factors, namely the external analysis, which looks at the opportunities and threats, and the internal analysis, looking at the strengths and weaknesses. In strategic planning, the company matches its capabilities on one hand, that is factors internal, with available opportunities, which are factors external, and takes actions to minimize the threats by it. The different factors that are available for internal and external analysis are outlined in the textbook, and I do urge you on page 46 and page 47 to go through the descriptions of internal and external analysis. Today, we will look at portfolio analysis, which is an important tool in strategic management in order to understand or appreciate where to invest money. The overall lesson here is for companies to have a portfolio of products, such I have already mentioned, a hotel, for example, that has accommodations, that has food and beverage, that has banqueting, that has maybe a wellness department, and thereby is composed of a portfolio of products which are at the different stages of a product life cycle. So, for example, we have mature products that generate the cash needed for investments into new products. Product management actually calls for managing this entire product portfolio in line with the overall objectives of a hotel. As I said, the hotel's product portfolio might consist of different products. Two broad sets of factors, as we have heard in the SWOT analysis, namely factors external to the firm and factors internal to the firm, determine respectively the attractiveness of market opportunities available to individual products and their competitive ability to exploit those opportunities. Other things being equal, a firm is more likely to retain products that compete in attractive markets and consider for possible deletion offerings that compete in less attractive markets. Similarly, a firm is more likely to retain products that are in a strong competitive position and consider for possible deletion offerings that are in a weak competitive position in their respective markets. Proceeding a step further, a firm may be in a position to arrive at a better product retention deletion decision by jointly considering both external and internal factors rather than basing its decision on just one of the two. For example, joint consideration of both the relative market attractiveness and the relative position enables a firm to group products into four clusters, as you can see here. Uh, a cluster, or the cluster number one, relates to a high relative attractiveness of the market, as shown here, and a strong competitive position, which is outlined here. Uh, the second cluster has a low attractiveness and a strong competitive position. And the third cluster has a high attractiveness and a low competitive position. And on the fourth cluster has a low attractiveness and also a weak competitive position. Looking at this chart that I have outlined for you, we can see that the portfolio analysis as a tool to manage resources for SBUs. And as you know, SBU stands for Strategic Business Unit. The model that I'm showing to you here is the BCG Growth Share Matrix. BCG stands for Boston Consulting Group, and Growth Share Matrix describes the two dimensions outlined in this matrix. On one hand, we have the market growth rate, which expresses the market attractiveness of a business. There is one factor: the higher the market growth rate, the more attractive a business or a market is. The lower the market growth rate, the more unattractive a market is. The market growth rate thereby describes the market attractiveness either being high or either being low. On the second dimension, we have the relative market share, which I have already explained to you. And the relative market share composes a measure for competitive ability. The competitive ability of a business could either be strong or it could be weak. So therefore, here we combine external factors such as the opportunities with internal factors such as the company's strength and weaknesses. However, before the products in a firm's portfolio are grouped into 4 or 9 or any number of strategic subgroups, the company must address an important issue, namely, what should be the basis for assessing relative attractiveness to the markets in which a firm competes, and its competitive ability, as we have shown in this chart. Once accomplished, it could choose between two broad approaches. Select one factor, as we've done here, with market growth rate for attractiveness, or select a subset of factors for the market growth rate. The same holds true for the competitive ability. We can use one factor, such as relative market share, or a group of factors, such as various factors that I will explain at a later stage. In the BCG growth share matrix approach, the offerings that constitutes a firm's portfolio of businesses are classified into 4 homogeneous subgroups. The basics for classification is the growth rate, as I had mentioned, of the markets which the products compete, and their relative market share in this market. Market growth rate is viewed as an indicator of relative market attractiveness, and relative market share is viewed as an indicator of relative competitive position of the products in their served markets. And as shown in the figure outlined here, we have stars which are composed of high relative attractiveness and high relative competitive ability. We have question marks, which have a high attractiveness and a low relative market share. We have cash cows, which have a low market attractiveness and a high relative market share. And we have dogs, which are referred to as products which have a low relative attractiveness and a low competitive ability. A number of writers have questioned the wisdom underlying the use of barnyard language to describe the various quadrants, as I have just introduced them to you, as well as the organizational moral implications of assigning somewhat demeaning labels such as dogs. Some organizations that have employed the growth share matrix have coined their own names for the various quadrants. So you can actually use it the way you actually want. The products in a firm's portfolio are presented as circles in the matrix. So the products that are within the matrix are assigned in circles here, which are in proportion to the relative size expressed as annual sales. The centers of the circles representing the products, coordinate values along x and y axis, correspond to the offering's relative market shares and market growth rates. Grouping products into homogeneous subgroups is accomplished by using somewhat arbitrary cutoff points. Those are the arbitrary cutoff points that you see here in order between high and low market growth rate and high and low relative market share. Markets characterized by growth rates of 10% or higher are generally viewed as high growth markets, and those with growth rates lower than 10% are as low growth markets. In a sense, the high and low categories along the market growth dimensions are proxies for the growth and maturity stages of the product market life cycle. On the other dimension, a relative market share of 1 or 1.5 is generally used as a cutoff point, as you can see here, to differentiate between high and low relative market share. However, there are no hard and fast rules for determining values that are employed as cutoff points for the horizontal and the vertical dimension of the BCG matrix. Since cutoff points are judgmental and arbitrary, it is advisable to repeat the analysis by using different values as cutoff points in order to check on the matrix. Industry or market growth rate is defined as total industry market sales during a period, let's say a year or a month or whatsoever. Sometimes market growth rates greater than 0 or equal to 0 and less than 0 are indicative of a growing market, a static market, and a shrinking market, respectively. Given the diversity of a firm's product offerings, the industry market growth rate is generally expressed as sales growth rate in constant euros. The BCG approach views a market characterized by a high growth rate as more desirable, and I'm sure you would agree, than one with a relatively lower growth rate. However, markets characterized by high growth rates might not always be the most desirable market. Sometimes high growth markets might be characterized by intense competition and therefore not advisable to go after. On the other hand, we have the relative market share as the ratio of the market share of an offering, so that of its leading competitor. Regarding the BCG definition of relative market share, the question, why is relative market share a better indicator of a firm's relative competitive position, then absolute market share we have already discussed, and you should know and be aware of uh, relative market share and their meaning. When we look at the next slide, which gives you an idea of what to do in the different quadrants of the portfolio, you can see the following, right? Managing your product portfolio requires decisions with regard to either deletion or retention, market share strategy, and cash flow outlook. So when we look at the stars, the deletion and retention decision is it should be retained. The market share decision is we should maintain the market share there or even build it. And the cash flow situation there is that those products that are aligned to the stars quadrant are self-sustaining. When we look at the question marks, the deletion and retention rate is a case-by-case analysis. This is why they're called question marks, because we don't know really yet whether or not we should retain or delete those. If we retain them, we will be building market share. If we would like to delete them, we need to harvest them. The cash flow decision there is that we need a lot of cash in order to maintain them. Let me go now to the next quadrant, the cash cows. The cash cows are those products that actually produce cash, which we can invest into question marks or even sometimes stars. So therefore, the deletion and retention decision, they should be retained. The market share should be maintained, and you should be aware of that cash cows are net cash generators. This is why they're called cash cows. And finally, the fourth quadrant actually is defined as dogs. Their deletion and retention decision is that we should certainly delete them. The market share decision is that we should be harvesting it, and the cash flow outlook there is it is a marginal cash producer, but does not have any perspective in order to keep carrying on. This is why they are called dogs. And at the end of the day, one should get out of those businesses in order to maintain an overall prosper development of an organization. Now, decision on which segments to target, we should now take a strategic business unit as a segment. And now you could evaluate segments. As outlined in this slide, we have taken on the critique of the BCG matrix, where we do have a problem by looking at only one factor for the relative attractiveness of a market and the only one factor for the competitive ability of a market. This is not very practical, because in the real world, the success or the failure of a strategic business unit does not only depend on one factor, but on various factors. So in order to help marketing managers with a decision which market segment to target, the decision support models have been developed. One of them being the directional policy matrix, which has been developed by Shell Oil. And the directional policy matrix, as you can see in this slide, has more than one factors to look at the segment's prospects and attractivity, and has more than one factors to look at the so-called competitive ability. The DPM matrix differentiates thereby between three levels of business sector prospects. As you can see here, we're not only talking about weak and strong, but we've included the average as far as the competitive ability is concerned. And as far as the prospects are concerned, we do not distinguish only between unattractive and attractive, but also have added the average. So instead of 4 fields, we have 9 fields, thereby developing a more specific and a more detailed, we call it a more sensitive way of looking at a business. Let me go further on the different options and possibilities that one have, like like the business screen. A desirable feature of the directional policy matrix DPM is the flexibility it offers in selecting factors relevant to the industry to assess business sector prospects and competitive position. The DPM approach employs the following sets of factors to assess prospects and competitive ability. Looking at the segment's prospects, we can look at market quality, such as the size of the market, the seasonality, the profitability of a market segment, which is indicated by its price that is achieved, and the growth rate. So this is what we call market quality, and you can pick one or two out of these factors. The size of the market, the bigger a market is, the more attractive it is. In the seasonality, we could be saying the more often a market uses us in off-season, the more attractive it is. The profitability, as I said, is indicated through its price. The higher the price, the more profitable a market is, and its growth rate. The higher the growth rate, the higher the growth rate, the more attractive it is. Then we could take a look at the industry situation by the number of competitors, which we have already heard. The more competitors there are, the more unattractive the market is. The less competitive, the more attractive. The degree of differentiation, as you have heard, the higher the degree of differentiation between competitors, the more attractive a market is, and the lower, the more unattractive. Entry and exit barriers, as we have discussed in our last week's lecture, the lower, the more attractive they are. And the degree of integration, the higher the degree, the more unattractive, the lower, the more attractive. We can also add environmental aspects into our analysis, such as the dependability on suppliers and buyers or government regulation. When we turn to the competitive capabilities of our matrix, we can talk about the market positions, which is expressed through the actual market share and the relative market share. We can take the product potential, such as the potential market share, the product offering as such, as it is taken from the strength and weaknesses analysis or the importance performance matrix, and the capacity usage, which we have also discussed already. The production capabilities extend to the experience somebody has in a market, the available know-how, and the financial strength. The relative importance as a third aspect in a portfolio will relate to the contribution each of those segments is making to the overall success or its potential. So you have a variety of factors that can be composed in order to develop a meaningful matrix, as shown in the next slide. Here we have the three aspects we have the competitive ability divided into strong, average, and weak on on the y-axis, and we have the segments prospects, unattractive, average, or attractive on the x-axis. As you can see here, the different segments that we have introduced have different sizes, and the larger a segment, the larger a size of a circle is, the higher its relative importance for the company. The smaller the circles are, the less important it is as far as its relative importance or contributions to the success of a company is concerned. Now, we have here named various strategies or strategic guidelines, as you can see here. One that I would like to start with, like segment A, which is the so-called party tourist, uh, where we have suggested to disinvest. Segments falling into this area will probably be losing money, obviously, because their competitive ability is weak and the segment's prospect is also unattractive. Not necessarily every year, but losses in bad years will outweigh the gains in good years. Then we have something called the phased withdrawal. Segments in this category are unlikely to earn any significant amounts of cash. The recommended strategy is designed to help realize the value of the assets on a controlled basis to make the resources available for redeployment elsewhere. So don't waste your money and get out of the business. Cash generators, as outlined here, a typical situation in this matrix area is when the company has a segment which is moving towards the end of its life cycle and is being replaced in the market by other products. As long as the business is profitable, it should be used as a source of cash for other areas, namely the cash that is generated here can be used in other areas of the matrix. Every effort should be made to maximize profits. Investments in expansion may not be appropriate. Proceed with care, custodial. This is this area here. Some investments may be justified, but major investments should be made in this field with extreme caution. Growth, the growth area, which is outlined here, okay, segment F, for example, investment should be made to allow the business to grow with the market. Generally, the segment will generate sufficient cash to be at least self-financing, but the perspective is that they will become cash generator. Then we have double or quit up here. Tomorrow's breadwinners amongst today's segments may come from this area. Business with the best prospects should be selected for full backing and development. The rest should be abandoned. Then we have try harder, which is this field here. Through judicious application of resources, businesses in this cell can be moved towards the leadership cell, which is down here. It may be desirable for the firm to make available resources to these businesses in excess of what they can internally generate. And last but not least, we have the leader section, which is outlined here. The strategy should be to maintain this position despite above average earnings. In certain situations, segments in this cell may need resources in excess of their internal cash generating ability. So with this matrix, you have a real good indicator or strategic advice of what to do with the individual segments that you have created in the segmentation and which you have analyzed in the competitive analysis, and thereby in one picture, and that's the good thing about it, you can actually get some strategic guidelines of what to do with those segments.